So there's a presumption that HFTs are trading the same way that we trade, and that is a false assumption. So the key to high frequency trading is the repetition of a large amount of small, relatively risk-free trades. Now, some of the larger firms doing this are firms like Citadel, Knight, Jump, Getco, Virtue. There's a lot of big firms doing this, and these firms are trading massive volume. Now, in 2012, the model broke down at Knight Capital due to a software glitch, and this is a firm that in the first half of that year was responsible for 11% of all equity trading in the US, and that is massive. And one day they had a glitch. We probably call it something other than a glitch when you know that they lost $172,000 per second for 45 minutes before they realized. And if you look at this article, you can see right at the bottom it was due to a bug that had infected its market making software. And this is the key to understanding HFT and algorithmic trading. It is not directional trading. In this case, Knight were making the markets, in effect providing liquidity in a market where they felt it is safe to do so. And of course, there aren't that many ways to decide whether it's safe to do so. So we have a lot of algorithmic market makers providing liquidity when they feel it's safe. When they feel it's unsafe, usually for the same reasons as everybody else, they all get out of the way. And this is one of the reasons we see these mini flash crashes where prices collapse and then recover just as quickly. So these flash crashes are not moves created by orders coming into the market, but by orders and liquidity actually being removed or pulled from the market. So it's not a move created by the desire to profit, but a move that's been generated by the desire to avoid risk by pulling orders. Now the market relies on algorithmic market makers being there, so when they all disappear, even momentarily, the bottom falls out of the market. Now overall, there's little benefit in tracking this sort of algorithmic market making activity, even if you could do it. These small market making trades are actually not moving the market. They're just in and out of the market all day, just chipping away at the market and taking small, relatively risk-free profits over and over again. Now another type of algorithmic trading is arbitrage, which again represents a massive proportion of all trading. Now there are many different forms of arbitrage, and the common characteristic is a theoretical low risk or lower risk compared to trading outright or naked unhedged positions. And it's simply the process of trying to make money from some sort of price discrepancy. So for example, index arbitrage is trading an index derivative such as the S&P 500 futures against a basket of stocks. So when the futures and the stocks diverge too much, for example, the futures go up and the stocks go down, then an arbitrage opportunity occurs, and then they would sell the futures and buy the stocks. The risk to the trader is that the instruments continue to diverge and they end up with two losing positions, but that is quite rare. And it's arbitrage that keeps related markets in line. In fact, as competition increases for arbitrage opportunities, the potential reward for those arbitrage trades gets smaller and smaller as people or algorithms are prepared to step in front of each other and trade a smaller and smaller price discrepancy. Now on an index arbitrage, we might see a large buy order placed on the S&P 500 futures and a corresponding sell order on the stock market, but the algo doesn't care what happens on either of those trades. So you can't beat the futures part of that trade. It's not a position that will be defended. It's got no traditional technical stop loss. It is market neutral. It is the actual combination of the pair of trades that actually makes a profit or loss. Now, if most algorithmic trading is a form of arbitrage or market making, then it's not particularly predatory. But that doesn't mean predatory trading doesn't exist. But from a risk perspective, predatory trading is a massive step up from HFT. So HFT tries to be low to zero risk, but predatory trading is going against other weaker traders taking on a large position over a period of time and is inherently risky. So predatory trading is also a step up in terms of time consumed per trade compared to HFT. So that in turn means much fewer opportunities per day. So to be a predator, you're looking to catch people offside. And these are little plays, a bit like bluffing in poker. So in this example over here, we can see we've got spoof or fake orders up here on the upper side. and we've got an iceberg order here on the bid side absorbing the resulting selling. So by definition, this sort of activity, this sort of predatory move must be given time to work out. So you need people to kind of feel they've got an opportunity to go short, sell the market, and then get stuck selling into your bid. So if you only put the fake offers up there for a microsecond, there's not many traders actually going to see it. Now, not only is predatory trading risky in terms of the large position taken, there's also the risk of a fine or a ban. And in this case over here, a guy called Nitin Gupta was doing something called flipping, sitting with large offers out there, trying to encourage people to sell, and then having an iceberg order on the bid, buying from those sellers. And when he'd bought enough, he'd pull the offers and start buying to nudge prices up and get those sellers stopped out. Now, a few things to consider about predatory traders. First of all, these guys are opportunists, not daredevils. So they can't stop a one-way move. So when a market is heavily directional, they aren't in a position to step in front of that and push it around. Predatory traders thrive in range-bound market conditions. So when a market becomes quiet and is ranging, it's relatively easy to nudge a market outside the range and then back in to stop out reversal and breakout traders. Predatory traders cannot see your stops. In fact, they don't need to. They've got a good idea where they are anyway. The fact it appears you're being taken out by someone is probably down to the way you trade, not some predator who's following you around. But also, predatory traders will not push the market 8 ticks to get to your one contract stop order. So the cost of that outweighs the potential rewards. Now, this does somewhat fly in the face of all the talk of the algos taking the markets up 10 points, because a lot of people do believe that trading algorithms are moving the markets 10, 20, 30, or even 100 ticks. And the question to ask next time you hear somebody saying this is, how do they get out? So let's say you wanted to push the S&P 500 futures up 10 points. You'd most likely on a normal day be looking to buy in the region of 80 to 100,000 contracts, so actually make the market move up 10 points in the US daytime. So let's say you did that. You successfully moved the market up 10 points. What do you think would happen when you try to exit that position? You'd have to sell those 80 to 100,000 contracts to exit. And if you did that, the market would go right back down. So if the market moved up 10 points on your 80 to 100,000 buys, it's going to move down 10 points on your 80 to 100,000 sells. So whenever somebody is telling you that an algorithm is making something happen, just ask them, which company is running the algo? What's their strategy? And how are they going to work their way out of that trade? And of course, you're most likely not going to get an answer to that, because it's just a trend thing in trading right now that has people shouting algorithm every time the market moves. So the art of predatory trading is not to just push the market around a huge amount, but rather to get other traders to do all the work, whether enticing you into a bad trade or running your stops. So they're looking to cause a reaction and then to be out when that reaction is complete. So this isn't moving the market tens or hundreds of ticks, but rather getting other traders offside so that those traders move the market 5 or 6 or 7 ticks with their stops. And the bottom line is that HFT is in and out of the market so fast that by the time you know they're there, they're already out. Longer term algorithmic trading is all about arbitrage. So what we're left with is a trading game, the same old game, one where you don't need a PhD or expensive toys to analyze and trade it successfully. So what does it mean to stay on the right side of the market? Well, there's a couple of things. Partly it's judgment and partly it's luck. Because in the short term, it's judgment that gets you into trade when conditions are good. When your overall analysis has told you where an entry might be appropriate, it's a mixture of contextual analysis and trade entry refinement. And then there's luck, because once you get into the market, any number of things can happen that prevent you from getting to your target. And the longer your trades last, the more likely something unexpected will occur that turns the market against you. And that is absolutely fine, something we all live with. Now, my personal focus for getting an entry and then staying with a trade is on understanding short-term speculation, where the pain points are and where short-term speculators might come into the market. Because most of the time, short-term moves are driven by short-term speculation. In other words, there's often not a lot of long-term institutional trading moving the markets. Then there are times when volume spikes, often after news, where we can say that exceptional volume is driving the markets one way, and that is most likely to be institutional volume. So those higher volume, heavily directional periods are theoretically easy to trade, although if you've tried trading them, you know you sometimes have to sacrifice getting a good entry price just by jumping on board, or the move just passes you by. The average volume, speculation-driven days often have 3 or 4 major intraday swings or short-term trends, and on these days, the right side of the market changes many times as speculators take profits, get stuck, or see profit more likely in a different direction. So on those days, getting a handle of the flow of orders helps us to understand where speculators are trading right now and where they're getting stuck. But a word of caution, with the advent of attractive looking order book heat map tools, there is going to be a natural tendency to focus on what is the most visually stimulating. It's the shiny effect. So we shouldn't lose sight of what is actually important or what activity these charts really represent. So we need to carefully consider how much weight we give to market depth information, which is, after all, the prettier information, compared to the actual order executions and what they say about other traders' positions. After all, the market depth is intent, or at best, what might happen. But the order executions tell us where people actually traded and what the impact was. And we should think about this another way too. Historical versus current information, because this isn't about which view is best for reading the market, it's about which view is best at which time. Now on the screen here, we can see market depth in a couple of places. First over here on the dome, or the depth and sales, with the inner blue and inner red background columns showing us the bids and offers. And outside of that, we can also see the changes to those bids and offers. So we can see here at 30.46, we have 26 offered, and also that 16 contracts have been added to those offers since we get there. And that information is current, it's right here, right now. Then over on the left, we can see the auction vista chart, and we can see the offers above in red and the bids below in blue. And the lighter colors indicate areas where there's more depth in that area. Everything left of the vertical line is history. So to the right of the vertical line, that's current, but the left is all what's already happened. Now we can see order executions on the depth and sales here, with these current trade columns showing sells that sold to bidders in red numbers here, and blue buys that bought from offers in blue numbers here. And this activity is just showing you this time round. It's not cumulative, and it'll be reset when you come back to a price. Now on the auction vista chart, we can see the executions in 2 ways. Between the yellow lines here, we have something called a trade thermometer, and you can see over here we have a long run of red, and that means that during this time the aggressor executions, the market orders submitted, were mostly sells, but overall the volume was not significant. Then we have these large trade circles that show when exceptional volume trading occurs, not at any specific interval, but over time at a price. And the size of the circle reflects the volume of trade, and the coloring represents a balance of trade. So the more blue represents more buying, and more red represents more selling. And you can see those circles develop in real time as soon as exceptional size is detected. Now a lot of people seeing this will be attracted to the charts and feel put off by the fact there's numbers over here on the trading dome. And a trading dome, it's all about current information, it's all about right here, right now, but surprisingly, it really isn't all about numbers. It's really about the pace of the market, the way it speeds up and slows down. It's about seeing prices that are sticky and prices that we can't hold or even for a second. Of course, it is also about how much volume it takes to get through prices, but mostly it's about the way the market's moving right here, right now. Now we all know that some market depth is real and some is fake, and sometimes the market depth reacts to price approaching it, and sometimes price reacts to the market depth. And in this case, we can see here exceptional sell-side depth that was real. We'd been as high, excuse me, my voice is breaking. We'd been as high as 30.61 on the day. We'd come down to 30.46, and this is a retracement back up to 30.55. Now at this point, as a trader, you might be waiting for a double top, or you might be waiting to get short on a failed retracement. Now on the way up to 3065, we can see exceptional depth above us. And at each price, we traded into that exceptional depth and the offers stayed firm as we traded through them. And we can see that because we've got a circle at each price, and the circles tell us that it took exceptional volume to trade through exceptional depth. Now on the way up, trading wasn't balanced. The aggressor side, the market orders, were predominantly buyers. You can see all these blue circles. And that's pretty normal. In any move up, you're going to expect an imbalance of around 1.5 to 2 times buyers to sellers with price progression. So buyers were in the majority on the market order side, and sellers were quite happy to progressively absorb more and more of that buying as the market moved up. Now the imbalance is much higher than 2 to 1 as we reach the turning point, and there's a noted lack of aggressive sellers. We don't have sellers hitting this market. And the reason for that is there's no need for smart sellers to sell at market, because the smart sellers are sitting on the offers up here absorbing the buying. Now as the market rolled over, we can see that moderately high offers follow that market down, and that's typical market maker activity, looking to pick off traders that take trades against a trend. So when you see this, where do you enter? Well, first of all, let's remember context. We're in a pullback, in a move down, which is good contextually, but without that context, you'd sit on your hands. You could enter when you see these high offers, but that's actually a little hit and miss. Even if you're potentially in a new downtrend, you can't generally just sell in front of large offers or buy in front of large bids. It would be nice if you could do that, okay? If you want to try it on sim, but generally speaking, the high offers, it's not enough. So for me, it's extremely rare for me to make a decision to enter a trade because of high bids or offers. So while it's useful information, it's not enough on its own. Now where I'm more likely to enter is when these stuck buyers look to be getting stopped out. So we can see that the sellers were absorbing buying from 3053 to 3057. So that means we have a cluster of short-term new long positions there, and when we start breaking to the downside, those long positions will start to unwind, and that will help us move down. And that is the point at which I personally be looking for refinement over here on the dome. So I'm watching the market then tick up and tick down, looking for the ticks up to be weak and short-lived, watching for signs of downside momentum to build. And we can see that to an extent on the trade thermometer in this area here. Even there's no exceptional size, we can see on the way down it's predominantly sell market orders. Now a lot of people ask, well, what's the signal to sell? And that's a fair question, but generally speaking, the signals to sell are quite nuanced and quite personal to your own risk profile. So the 4 steps or the 4 phases in the turn: first, we see depth above us. Could be resistance or it could be fake. What it does mean is this is an area of interest. The second, we trade into that depth and the depth doesn't move. It doesn't pull out of the way. The depth is real. Third, we trade exceptional size into that depth. It means in this case that buyers are getting stuck. Now they don't all have to be buyers initiating new trades here. Some could be exit orders, but on balance there'll be enough, there'll be a good enough proportion of new long positions here to help us when they get stopped out. And then the last step is when the market starts pushing down, pushing those new speculative buyers out, and at that point the probability of a profitable short trade increases, but you do lose a few ticks on the entry price because now you've got confirmation, market's moved away, it's not as good a trade from an entry price perspective. So at any point from seeing large offers above to the buyers being stopped out by the move down, we could have gone short. And where you go short really depends on your own tolerance for risk. Now this image is typical of cases where a turn in the market is defined purely by order execution and the depth itself isn't adding any additional information or significant information. So we've got iceberg orders being executed, we have hidden backstops being created, and we have something called opposing imbalances at the extremes. Now as we can see, the market moves up to 1912 but just can't push through. Yet the depth as we arrive up there is quite normal. So the volume that we accumulate at 1912, we can see over here 38.70 is what we trade is exceptionally high. And the aggressors, as we can see by the blue circles, are mostly buying. And price can't move through 1912, yet we see no sign of large size on the offer side. And that is only possible if there's one or more iceberg orders on the offer side. So as buyers buy, more contracts are added to the offers, and those buyers get trapped. So if there's no large depth, but you see an excessive amount of trade, a large trade circle, you look at an iceberg order. So that's somebody on the sell side trying to hide their size. And this sort of activity, this stopping at a single price with large trading at a single price, is very typical of thicker markets like the S&P 500 and US Treasury futures, but it's quite rare to see this sort of thing on thinner markets like crude or DAX, when a market tends to trade high volume over a series of prices before it reverses. I also mentioned something called an opposing imbalance. So what is that? Well, we're imbalanced on the buy side at a high. So buyers are active in terms of market orders, but sellers aren't. The smart sellers are simply there on the offer side, adding to the offers as buyers buy. So there is no reason for them to be putting in sell market orders at this point. So at reversal areas, you absolutely want to see the market imbalanced to the buy side at the high or to the sell side at the low, hence the term opposing imbalance. And it's not just the circle size itself that's important, the imbalance is important too. Because at a high, you want to see buyers trapped. Now, of course, you don't have to enter when you see the circle. In fact, it's often better to enter when you see the market start to break down. So don't think of this as a chart with a single entry point. You can get in when you see traders trapped, or you can get in when you see the market move against them. Now, sometimes, and always think about this when you're trading order flow, there is as much information in what you can see as what you can't. For example, we can't see excessive offers at the high, but we knew they were there, and we know they're trying to hide because we saw excessive buying that didn't move anywhere. So once again, think about what you see as well as what you don't. Now, I like to separate turns in the market into major and minor reversals. So a major reversal would be one that initiates a new intraday trend, and a minor reversal would be a simple pullback. Now, the end of trend moves are always going to be much busier because there's more trading involved in reversing an intraday trend than a pullback. There's more people engaged there, and it also means it's a spot where you're going to find more predatory traders. So in this image, I've actually got the depth tuner set up here to 3 to just show the most significant depth. That's why some of it appears to be missing. And we start this image with some consolidation after a move up. And we move up from this consolidation zone and then back down into it. And this is our pullback, and a very typical pullback too. And we can say a few things about the end of a pullback. First of all, it very often tests the high of the prior consolidation area. Second, sometimes an iceberg order will stop the pullback as bidders step in and absorb the relatively light selling. But a lot of the time, you simply run out of momentum. The sellers stop engaging. So this sort of turn, catching a pullback, is defined mostly by a lack of activity. So we don't see much. But this lack of activity is actually easy to read if you look for it. Now, as we get to the top, the full reversal, we can see a lot more activity. So we see an area of high liquidity above here as prices move up. And we can see as we move up, it's taking progressively more and more contracts to move through the offers. And we can tell that because the circles get bigger and bigger on the way up. And this is typical of a thinner market like crude, to see a market thicken up over a series of prices prior to reversal. So once again, we end up with a very large circle, so a lot of trade where the aggressors are mostly on the buy side, and after the market ticks up once more, it falls away. Now again, in terms of entry, entering on that high volume circle with the backup of the market depth above is a place you could enter the market, but in my opinion, it is also a risky area. It's the most rewarding area. So my own preference is, once again, let the market break down. see some downside momentum, or even wait for a weak pullback. As usual, the cost of confirmation is simply you give up a few ticks. So once again, it all comes down to your own personal risk profile. Now, in many cases, the market depth is actually quite irrelevant. It's just not a big part of the story. So in this image, we can see just one price here with significant depth. And we actually traded through that before an iceberg order held the market a few ticks lower down. So once again, we have the opposing imbalance, aggressive sellers at a low. And we know this is an iceberg order because the depth of that price was insignificant, yet a large amount of selling occurred and the market didn't move down. So for that to happen, the bidders must have been adding contracts as sellers traded there. But for the rest of the time on this chart, the market depth was absolutely insignificant. Now we can also see, again, the hidden backstop created by the trap sellers over here. And as we move down, we can see a lack of selling interest when we came back to that low. And that lack of interest, again, very easy to see, very easy to predict. Now many times you'll see a market eat through areas of high liquidity because sometimes that liquidity is just one half of an index arbitrage strategy. It's got no real bearing on direction. And over time, you'll learn that liquidity alone won't stop the market, certainly not reliably enough for a full reversal. So seeing that liquidity gives you a heads up that something may occur, okay? But it's the trades, it's the executions that tell you that traders are getting stuck, and also tell you that those same traders that got stuck before might be a little shy when you get to that price again. Right, now would be a good time to type in any questions if you have. It was just a quick overview of a few concepts when it comes to market depth and order flow. Now what you've seen is actually basic market activity, but considered from the perspective of where other traders have positions. We saw the Auction Vista order flow heat map giving us actionable information we could actually use in our trading. It helps us understand where traders are getting caught offside, and it gives us additional prices that become potential entry and stop out points based on areas with concentrations of positions. So when using order flow tools, you need to think in terms of how the market's playing out over time. So with a lot of techniques, we're looking for a static buy or sell signal that occurs in one particular slice of time. And that's not the way order flow works. It's more like reading a story. And the context is important too, because a lot of people come to order flow, they tend to throw everything away that they learned before, when order flow is really meant to build on everything you learned before. So you need context. You need to be reading order flow, looking for this kind of activity, looking for these trap traders in areas you're already trying to capitalize upon. So the end of a pullback, for instance, is often not only characterized by a lack of activity, but it's also usually a measured pullback. So when you've got a market moving like the S&P 500 that moves down 10 points, up 10 points, down 12 points, you'll often find that the pullbacks are quite uniform in size. So you might have a day where pullbacks are on average 8 ticks in size. So that's giving you the context, but then when you're actually at that point, you're looking at the order flow to actually see if there's anything there, if you've got trap traders, or if the market's slowing down, or if one side is kind of stepping off the gas, to tell you that now, yes, this might be a good opportunity. The market depth information certainly helps as a heads up, but trading against large depth on its own is a net losing strategy. Okay? By all means, try it on sim. The order book does give us a good heads up, but it shouldn't be taken too seriously in terms of giving specific signals on its own. Now, order flow doesn't replace good context, because good context gives other speculators a reason to trade too. Okay? And this is really, really important, right? If you've got a magic system that only you and 2 other people know about, that gives you unique signals that nobody else can see, the chances are it's not going to be making you any money because you are the only people can see it. Okay? So if you're looking for contextual clues in the market, you have to look for contextual clues that are fairly popular, because if you don't have people watching those areas, if you don't have other traders engaging in those areas, then nothing will actually happen. And one of the ways you can tell that people are actually looking at an area that's good contextually is you will see above average market depth in those areas. That is not your cue to get into a trade, but it is a cue to tell you that other people are looking at that area. Now we also have to say that the order flow does give you additional context. So hidden backstops do get created, and they do end up being both entry points and exit points because they should really hold on a test. And these order flow events that we're looking for, they play out over time, so not in splices of seconds or milliseconds. So the more obvious order flow events are the iceberg orders or large bids and offers, and the reason they're more obvious is because they actually play out over a longer period of time, and they generate areas of higher volume and stuck traders. But the less obvious events are the lack of participation, and those are probably the most rewarding things you can look for in order flow, and not too difficult to find as long as you start looking for them. As for the algorithms, well, other than being behind a lot of fear-mongering and sales pitches, I don't think you need to be overly concerned about tracking algorithms specifically. If we get to the point where a discretionary trader needs to react in milliseconds, well then we're already going to be beyond what's humanly possible anyway. So it really doesn't matter what tools you use if you want to look down at millisecond level. Now algorithmic trades are always going to be amongst all the other trades reported, and ultimately it's the sum of all trading that sets market direction. So if buyers overwhelm sellers, the market will go up, and when buyers no longer overwhelm sellers, the buyers get trapped and the market reverses. And that's a cycle that repeats itself over and over again. So with that, I'll just take a few minutes to go over some questions. There is a coupon code off the tools there. If a large trader has a position to unload, will it ever be in his interest to offload it with an iceberg? Absolutely, because with an iceberg, you can say, I'm going to put a limit order, I want to buy 2,000, I want to show 200. Okay, so you just put in a bid, say you want to exit a short position, you put in a bid, and people can only see 200, but as they trade into that bid, your bid, you keep refreshing, so they still do 200, they trade 100, there's 200 left. They trade another 100, there's still 200 left. And so that goes on. The only downside of that is that people won't trade into that forever. Okay, so it's a good way to start, in theory, it's a good way to start absorbing. There's a few downsides to it. First of all, the market's going to be going down to you. You might be actually the cause of the reversal, which means the market's going to go back up. So it might be a better idea to put in a little bit of an iceberg at one price and a little bit of an iceberg a few prices down and a little bit of an iceberg a few more prices down, and kind of spread it out a little bit. Same rules for level 2. I don't quite understand that question, JQ. But basically the market depth is the level 2. The trade executions is the level 1. So I do apologize, guys, for the technical glitch there. I have no idea what happened. I've got quite a complex setup here with a preamp that tends to blow up every now and again. Anyway, if you do want to contact me for more information, email address is there, peterdavies@jigsawtrading.com. If you want to know more about order flow in a lot more detail, there's 10 hours of educational material on our site. You are more than welcome to join our chat room or drop me a message on Skype.